Okay, so have you been looking at your portfolio lately, then glancing at the market headlines and just thinking to yourself, am I living in a different reality? Because you are not alone. The numbers just don't seem to add up. So let's get into it. Let's unpack this massive disconnect and see what it could mean for all of us in the year ahead.
And this right here, this chart, is the heart of the problem. It's why everything feels so weird. In 2025, the big, established companies, the large caps, they climbed a solid 11%. Pretty good, right? But at the exact same time, smaller companies didn't just stumble, they absolutely plummeted by 19%. That's a 30-point gap between the two. It's not just a divergence, it's like we're watching two totally different markets playing out at once.
So how is that even possible? Well, this is what we're calling a tale of two markets. We're going to break down exactly why the headlines can be screaming success while your own portfolio might be, well, feeling the pain.
This is the question, isn't it? It's the feeling so many investors have right now. You see the news shouting about new market highs, but you check your account and it's telling a much, much more painful story. It's that kind of disconnect that makes you second-guess every single decision you've made.
The thing to remember is that the market isn't some single monolithic thing. It's better to think of it like an ocean with all these different currents. And right now, the current for the giant megaships, the big companies, is pushing them forward. But there's this powerful undertow that's just dragging the smaller boats backward. And the gap between them, it is wider than we've seen in a very, very long time.
But here's where the story gets really interesting. What if all this pain is actually a setup? What if this crash in one part of the market is actually creating the biggest comeback opportunity of the decade? Let's flip the script and look at it that way. And listen, this isn't just wishful thinking. We're seeing some serious analysis from major financial institutions like Motilal Oswal and Kodak AMC. They're both forecasting a tale of two halves for 2026, pointing to a potentially dramatic reversal on the horizon. So here's how they see it playing out. The first half of 2026, probably going to be choppy, kind of like what we're seeing now. But the second half, that's where the fireworks could start. The theory is that as the global picture starts to clear up, the big money, we're talking major foreign institutional investors, will come rushing back in, and that could trigger a massive rally.
And this is exactly why some people are calling this a once-in-a-decade opportunity. See, for investors who can look past the fear right now, the contrarians, this isn't a crisis, it's a sale, a chance to buy into really good companies while they are deeply, deeply out of favor.
Okay, so if there's a huge opportunity, where do we find it? Well, the analysis is pointing to a very specific part of the market, a sweet spot that often gets overlooked, the mid-caps.
This number, 27x, tells a huge story. It's the forward price-to-earnings ratio for mid-sized companies. You can think of it kind of like a hype meter. Not too long ago, this meter was absolutely red hot. But now, at 27, it's cooled down a lot. And that suggests that these companies aren't just trading on pure hype anymore, but on more reasonable, grounded expectations, which makes them a much more attractive entry point. And it looks like the smart money is already making its move. These automated trading systems, they're programmed to detect what are called accumulation zones. That's when a stock is being bought up quietly, without a lot of fanfare. And the sectors that are lighting up their screens? Capital goods and manufacturing. That sounds like a pretty big bet on the backbone of the real economy. Now, this is all great in theory, but how can you actually spot these moments in the real world? Well, that brings us to a really specific strategy for identifying these potential turnarounds, something the source calls decoding the volume shock. To do this, you need a total mindset shift. Most people react to a falling market with fear, with panic, but a strategic investor learns to see it as a potential setup. It's all about switching from running away from the dip to actually hunting for the pattern hidden inside it. So here's the three-step playbook. First, you find a stock that's been kind of trading sideways in one of those accumulation zones we talked about. Second, you watch the trading volume. The key pattern you're looking for is high volume, but with very little price movement. That's a huge clue that big institutions are quietly buying up shares without trying to alert the market. And the third and final step is to wait for the trigger, the volume shock.
So what exactly is a volume shock? It's the final, unmistakable signal you're waiting for. It's when the trading volume in a single week is at least double its recent average. Think of it like a sudden roar from a crowd after a long, tense silence. It's a massive, undeniable surge in interest, and it's often the very last signal you see before a stock makes a major move. So we'll leave you with this question to think about as we head into 2026. With such a massive gap between the market's winners and losers, and with history showing us that these gaps almost never last forever, is the biggest risk really taking a chance on a comeback? Or is it playing it too safe and missing the rebound entirely?